Hello, hello, ladies and gentlemen. Welcome back to the Converge stage. We are at day number 1 of Switch 2025, and it's really lovely to see all of you. Now, coming right up, we have an amazing panelist lineup, and we're going to talk about financing beyond equity, the debt playbook for founders. So, gathering founders, investors, industry experts, and bankers, this panel will provide a comprehensive look at the debt playbook, covering where debt is the right move, how to balance it with equity, and the key trade-offs every founder must know before signing off on a term sheet. So to lead this conversation, please join me in welcoming our moderator, Sean Sakrani, Head of Credit Solutions Singapore and Asia Head of Platform Lending, Innovation Banking from HSBC. Joining Sean on stage, we have Andy Tan, Chief Commercial Officer of Atomy Financial. Next up, we have Dion Song, CEO of Love Bonito. And Tommy Leung, Head of Global Private Banking South Asia at HSBC. Handing the time over to you, Sean. Take it away.
Okay, thank you. Thanks, everyone. Thanks to the great panelists we have. Hopefully, have a very productive session this afternoon. I think to just give a bit of an overview, we have a group of, a diverse group of individuals on the stage, both from the banking side, from the operating company side, different businesses, and I think we're trying to navigate the sort of debt spectrum, the debt market as a whole, what is available, what have companies tapped, and Southeast Asia, those of us who have been based here for some time, it's a complex place, right? I mean, Singapore itself is a hub. As you go into other markets, you have jurisdictional issues, you have sort of quite a nascent sort of debt market. And a lot of what, I guess, Dion, Andy, and team have been able to do is actually navigate that market. So I think a lot of us today want to hear about your story, how you've been able to navigate the market, with HSBC alongside you, and where do you see the potential? People talk a lot about Asia, Southeast Asia as potential, right? Growth. And I do feel those of us based here have still not seen that potential being fully materialized, right? And I guess the more we do together, the more we can see the market advancing, more people getting comfortable, then how do we basically take things to the next level? So I think to start with, I'd probably say, like, from my own experience on the financing side, we see sort of financing debt as sort of that second product that has only recently got a lot more sort of limelight, right? Up till the last few years, a lot of us about equity, the top line, early stage companies trying to determine a high valuation, and people investing for the long term. And then essentially the dialogue changed towards profitability, right? Path to profitability, managing costs, trying to get a sustainable business model. And the unique thing, I guess, about debt, it's very backward looking, right? It's all about the past and having a history and stressing that history and lending on that basis. Equity ultimately is all about the upside. So I think maybe to start with, I'll probably ask both Andy, Dion to give their own perspective around how do you change the narrative, right? For early stage companies who don't have that history, but have a high potential for growth and have some operating history, how do you essentially change the narrative around debt and kind of increase the sophistication of the way lenders, debt providers look at these types of opportunities? Because I think we're looking at a very different mindset of very traditional covenants, very traditional businesses operating for many years, and now you're essentially looking at a non-dilutive form of capital. Ultimately, it's very, very useful if used appropriately, and it may have different use cases. So I'll ask maybe Andy, Dion to share a bit of their story of how they've been able to navigate the sort of debt landscape, and then I'll also probably open it up to your own idea about the different kinds of businesses. Atomy being a very capital-intensive business, Love Bonito being a very working capital-intensive business, and trying to understand how do these different kind of products play a part in terms of your capital raising journey. So maybe Andy, do you want to start first? Thank you.
Sure. Thanks, Sean. Thanks to the team for inviting me to speak. I think for us at Atomy Financial, where I am right now, debt is a very important component that powers our business, not only in Singapore but regionally. maybe I'll put it this way, right? Given that this room is largely founders, at the end of the day, it's about product market fit, right? For all to change the narrative and how you utilize debt, right? Think about your company as the product and the market as all the banks and all of the credit providers that you need to be matched with, right? At the end of the day, and they have certain mandates, they have certain requirements, they have certain special needs that their credit committees need, right? Completely different from what an equity investor might want, right? Off the bat. So I do think that the narrative should be, if founders do want to tap debt as a form of capital, and it is anti-dilutive, as Sean mentioned, then perhaps the starting point is have a look at your company, shape your company, and it takes time, right? Your financials, the way you grow, the way you operate, to sort of meet some of these debt providers' requirements, as a start, right? It is a negotiation. It is trying to understand the way they think, because bankers, at the end of the day, for the founders in the room, are generally professional managers, generally, right? They manage capital on behalf of the bank, right? And there are a set of guidelines that the bank or credit providers will accept. So rather than forcing them to fit your kind of requirements, if you really want to access debt in a big way, you really need to think very hard, listen very empathetically to what the bankers are trying to tell you before you can access it. So that's how I would think, I would sort of urge some founders who are on their journey to explore debt, right, to have a think about that in that manner.
Sure, Andy. And look, I can really add to what you're saying. When you think about how do you sell a story, right? Because to be honest, I would always say on the financing side, we're all storytellers to a certain extent, right? You're selling the business, we're selling the credit story, and how do we meet in the middle to get people interested in what we're trying to sell, right? And I guess with a business in the earlier stage, it's less about traditional financials, right? It's around, are you hitting those right targets? So many times when we think about KPIs, we think about metrics. Actually, at the stage of the business that you're in, it's very different metrics to the sort of more traditional companies that you're looking at. And I think that's the gap that we've been trying to solve for many years, right? Because we're trying to demonstrate, as long as you're making good on your metrics, that say you're scaling to a certain level, you're demonstrating certain metrics to a certain level, you're essentially on the right path to getting to that right level. Then the idea is that how do you scale it to the next level of growth? So I guess, Dion, sort of shifting gears a bit, when you say with Love Bonito, your business, your story, how have you thought about capital raising, and the mix between debt and equity, and how useful is debt for your own sort of ability to manage your own working capital cycle and growth as well?
Yeah, hi, nice to meet everyone. Oh gosh, I'm a little ADHD. It's very distracting over here with so much noises and everything. Hopefully you can hear me. I think it's actually quite noisy. So I think for those who are not so familiar with us, right, we're Love Bonito. We're one of the largest leading women's wear brand in the region. We've been around now 15 years, right? We have a presence across Singapore, Hong Kong, Malaysia, Indonesia, Philippines, Cambodia, and of course is a omni-channel, e-commerce first brand. We ship globally as well, right, to other key markets like Australia, the US, and whatnot. So, I think we've been around for a while, right? I think we're talking about debt as well. I think just to share sort of the journey, right? I think we started first raising more equity, right? So maybe a little bit of background as well, right? So we first started, and very different from Atomy, right? Given its fashion, it's consumer goods, right? Where I think as Sean rightly pointed out, of course, the biggest actually drain and usage on capital is usually then inventory, right? For any sort of consumer brand business. So I think that's also sort of the difference. And of course, I think we're not fintech, we're not AI, right? If you want to define it, it's a little bit more traditional, right? Just to be very blunt and very candid about it. So we first started the business, first 5 years, it was actually entirely bootstrapped. Really focusing on just local growth, right, in Singapore, since we are homegrown over here. And then we raised our first equity investment, right, from a VC in the region, Open Space, and I think they're in the audience as well if y'all want to meet them later for founders here. So I would say, I think when is the right time for debt? For a business like ours then, which is very traditional and also very easy actually for banks, right, to understand. You need, of course, key fundamentals, right? You need product market fit, right? And you need definitely cash flow, but of course also recurring cash flow, right? Is it consistent, right? Do you have a strong, steady base of customers who are not just coming in because of a strong NC, like new customer acquisition campaign or a one-off 1111? Are they coming in month after month, right, to continue to shop with you? And how is your returning sort of behavior like from your consumer base? I think these are very, very key fundamentals that at least a consumer brand actually needs to satisfy before even a founder should even be thinking about debt. Right? Because if not, then you're actually going to be in trouble and you actually can't pay back, right? And if you have PGs, personal guarantees, stuck to it, then you do not want to be in that place, you know? So I think just to be very, very candid, I think those are very important criteria to come through first. So thereafter, the moment sort of the business stabilized as well, right? We expanded also into the region. And we felt that, hey, right, I think from a steady state standpoint as well, if we look at mature markets like Singapore, Malaysia, you know, we started seeing, hey, right, revenue, cash flow, right, it's pretty healthy, number one. When we started expanding also to new stores overseas and even locally, we started seeing also key metrics, example like store payback periods, right? Are they healthy or not? Right? And then of course there are benchmarks for every category, right? Our payback periods are sort of an average of 12 to 15 months, which are actually pretty decently healthy. But it gives you then as an operator a very clear sense of also, hey, if I'm getting sort of like, you know, a capex facility or whatnot, what that sort of payback would also look like. And which month also, right, would the store then turn profitable? Right, which for us then pretty much, I guess, from start of operations, it is, right, pretty much profitable right from day one, right, from a profit margin perspective. So those are actually key metrics first that just gives us as operators the confidence, right, to even be engaging with the banks in a conversation. I mean, you could do it early as well, but to be honest, you'll just be shot down also, right? So it's probably not worth the effort. So I think that's really sort of step one. And then, of course, right, thereafter, it's, you know, I think maybe the conundrum and maybe this conversation, right, which we would love to see hopefully more people in the audience start coming in also. But I think debt maybe in Southeast Asia perhaps is still in very, very nascent stage where founders typically think of like, hey, right, even in Series B, Series C, let me just think about equity first, right? But if you think about it, especially for a brand like ours, does it make sense, right, to just be raising so much money to have most of it just go to inventory, for example, that end of the day it's going to be dilutive, right, to our ownership as well. Right? Does it make sense, right? The answer probably is no, it doesn't make sense. And there are probably better ways of doing that. So I think that's why also I think we started this partnership, right? Where from a working capital facility standpoint, it makes sense, right? From a revolver perspective as well, right? Or if we're thinking, let's say, term loans and so on, these are just sort of better ways also, right? To be just engaging, right? Banks like HSBC, to be directing towards especially growth, where we know that there is going to be a more predictable and a very clear sense of payback, and we are able to see that from with a high confidence level.
No, it's great, and I think I'll probably ask you another question before I hand over to Tommy. I mean, I think on the financing side, there are probably about two key issues I think are sort of pain points in many ways, right? When one is where we do all this work, we try to structure a transaction, and internally they say, I want a personal guarantee. It almost kills the whole analysis because with a personal guarantee, it's almost like I'm not willing to give value to the credit and all these mitigants don't matter. And to me, it's almost as if like it's a sign that the market is evolving, but it's still not quite there because in many ways, people always want to revert to the most simplest solution. In your perspective, I guess when you move away from the very, very sort of conservative way of financing to a more commercial solution, how does that help you tell your story and get the message out there? Because ultimately you're moving away from being very tied to sort of the founders and you're moving to the business standing on its own and being willing to survive on its own and obtaining capital providers to look at the business on its own. So that's one point is around how do you, like from your perspective, I imagine personal guarantees or wanting bankers to look at the business on its own is a key priority, right? And it's just how do you also view the banks that look things very conservatively? Is it very much it's very difficult to educate that market, or do you feel they can be basically guided along with sort of a partner, say like HSBC, to help bring them along the curve? And I guess the second question is that private credit, we talk a lot about private credit in the market. Do you see that playing a very big role in your ability to extend runway, to essentially obtain liquidity that, you know, it's non-dilutive, but it can just sometimes be very expensive and very restrictive in terms of impacting your ability to grow as well? Yeah.
Sure, I can take the first question on maybe the PG first. I mean, I think in the early days, the reality, at least in this region, right, I think from our experience and also, of course, I think knowing the landscape and other founders as well who have sort of gone through that also early stage. I guess PGs are very typical. It's sort of the reality, perhaps in the early days, that I think many founders unfortunately just have to be comfortable with, right? And perhaps I think if you think about it also from a risk profile in the early stage, if you're sort of maybe just post A, B, and so on, most businesses also even are typically also still quite heavily founder-led at that point in time, and also predominantly still probably founder-owned. I think we were only able to get past, right, sort of that stage, right? I think when we sort of had a little bit more maturity and scalability as well, right? And of course, with HSBC as well, I think y'all also then understood as well, right? That, hey, I think this business as well is now beyond also the founder, right? There is a team that's running it. There are, like decent operations, and there is also that financial discipline and rigor that you also then sort of like, I think had that confidence as well. But I do think the reality is it did take some time, right? And not all banks are definitely going to be comfortable with it. So it's probably important to have those open conversations, right? I think to ask as well, right? I think what are the requirements? How do they think about it, right? Is there sort of a threshold or a turning point as well, right? Sure. For them to actually remove the PG, right? And just have that open conversation and not be shy about it, yeah.
I think on the point of private credit, so for Atome's business and like Love Benito, we are present in the ASEAN 5, Singapore, Malaysia, Indonesia, Philippines, Thailand. Every country has its own different set of requirements when we access debt, right, as a way of powering our business. And because we are a fintech and that provides a lot of wealth and lending services in the region, right? We do need, money is our raw material. We actually need a lot of money to grow, right? So for us, private credit interaction is in the less matured stage is of course very important, right? They provide us that boost in growth without necessarily using equity to grow, because equity is very expensive. To Dion's point as well, right? I mean, raising equity just to feed loan book is very expensive, right? So private credit is part of our toolkit. We have facilities from private credit providers. But I think there is also a slight difference in the market there as well, right? When you have a venture debt provider or in recent years as well, because of the equity sort of slowdown until recently, a lot of the facilities will always have that element of a bridge to an equity takeout. And that sort of market has slightly disappeared in recent years, right? So it's really back to the fundamentals again, understanding the business, making sure we deliver the gross profit, revenue, EBITDA that is required for lenders to understand us better.
Sure. And I guess within HSBC, I mean, we're always trying to offer a very holistic proposition, right? So maybe I'll hand over to Tommy a bit now to talk about, I guess, on the founder side. So apart from financing on the company side, on the founder side, what are some of the solutions that we're offering to help offer, a fully sort of full range, one-stop shop for the companies?
Yeah, great questions. In the private bank, we work very closely with the founders and entrepreneurs. If I look at the private bank, we have about 15,000 clients across the region. More than 2/3 of them are entrepreneurs. So either they founded the company not too long ago, or their parents or grandparents founded these companies. So one of the things that we do is really connecting our clients to companies like Love Bonito, like Atome, because these clients really care about them. They want to be potential investors, potential partners, potential mentors. Just to give you some examples, since we're talking about private credit and private debt, in the last 6 months or so, we have done about 3 transactions in this region where our clients financed some of these startup or the founders of those startups. I'll give you a few examples, right? One is a data center in a 3rd-tier city in China, and the investor is a Singapore entrepreneur. In that case, in all those cases, HSBC underwrite the loan, but we sell a portion to some of these private individuals. In the second case was a wind farm in South Korea. And in the third case, it was a Vietnamese conglomerate. So we do a lot of that. So earlier, Andy talks about, oh, there's a certain template that banks like to follow. Well, guess what? It's not just us. We have to explain to the investors that these company meets the following criteria. And earlier, Dion also talked about the topic of personal guarantee. And frankly, our investors, the very first question they ask us is the founder providing the personal guarantee on the loan? They want to see that commitment because they remember way back when they started their company, they also give personal guarantee. Now, in addition to this, I think if you look at the private banking space, there are really three things that we work with the founders on. Number one is to really understand their needs and liquidity needs. A good example is about managing their tax liabilities because taxable events and liquidity events don't often coincide. So sometimes you have to pay tax when you don't have the liquidity to pay tax. I think there's some very famous example a few years ago, whether in China or in Southeast Asia. So that's the first thing, helping clients extract liquidity wherever they can find it. The second thing is really about planning for future successions. I know most founders are very young, but take it from a middle-aged man, time flies. You know, one day you're 25, the next day you wake up, you're 35, 45. So life happens very quickly. So before you have a liquidity event, before you go into IPO, put the assets in a trust for succession planning, for asset protection, so on and so forth. And last but not least is diversification. In the last 10 years or so, I used to work very closely with a lot of Chinese tech founders. It was boom time. You may remember between 2015 to 2021, every 2 weeks, there's a new Chinese billionaires. But imagine you're one of them. Overnight, you became a multi-billionaire. Guess what? 99.99% of your wealth is tied to one single stock. And the financial market can be tremendously volatile. So the key here is to really diversify that wealth because you don't want to lose that wealth again. Again, that's where the private bank comes in.
Oh, fantastic. I think shifting gears a little bit, I guess a lot of this is around sort of marketing, selling a story, right? Because ultimately financing is all around your ability to sell a story to the marketplace. And within the equity world, debt world, a lot of it's around a herd mentality, right? People buying into a certain idea, looking at upside on the equity side, and protecting their sort of capital deployed on the debt side. And in many ways, I guess a lot of the work you do with both sets of investors, there's a lot of commonalities, but there are things that are quite different. So I think as we think debt would be a lot less sophisticated, a lot of room to grow. Where do you see you can leverage off the work you're doing on the equity side to support your debt story and vice versa? So I guess the question is really around how do you ensure that whatever you're selling on the business side helps on your equity story selling? And then how do you use that to sell on the debt side and where the difference is really? So then I guess on an investor side, they can really see where the pockets of demand are and how do they think about what's important for each set of investors.
I think for Tomei Financial, right, at the end of the day, the debt story is slightly different from the equity story, for sure, right? Equity is about growth, it's about, a vision for the future at some level. While the debt story is all about making sure we repay without the personal guarantee being triggered, and we pay the interest, what is owed to the banks or the private credit lenders. All they want is P plus I. They don't need your upside. They don't need the growth, that kind of 10 times valuation, 100 times valuation, right, to get repaid. So I do think that we are always more cautious about overselling to the debt providers, because all the debt providers need to know at the end of the day is they're going to get their money back plus interest, full stop, right? So that there is obviously upside, and our company is always looking for the upside, growth story, etc., etc. But first, the fundamental is we need to be able to repay back the loan we took. So it's all about making sure that our financials are up to scratch, having a good auditor that is recognized, reputable, is very important. Staffing up your finance team properly to be able to answer proper due diligence question and not just say, hey, by the way, I think the market is great, we're going to get there, right? I think that is probably not the storytelling we tell to our debt investors, right? We always tell them about how the business is growing steadily, every dollar we deploy out, makes a return profitably, etc., etc. So I do think the story is very, very different. As I started talking about product market fit, the debt investors are a very different kind of market for us.
Yeah, no, I completely agree, Andy. And I think as you're speaking, I'm also thinking about our experience working together. The reality is as you go into new markets, you'll have jurisdictional risks, you'll have enforcement risks, you'll have currency risks. You can't hedge it entirely. I mean, that is expensive, it's uncertain. And in many ways, you're trying to balance being structurally sound and growth, right? Ultimately, if you try to hedge every risk, you can't scale. You need to be kind of nimble, but at the same time, be thoughtful around the risks. And a lot of us are trying to have the right balance. So I think the way when we try to operate on a financing partner, you're right, the quality of the data matters the most, right? Because if something goes wrong or there's sort of glitches or breaches or sort of volatility, we can see the source of that. So it's almost as if like, if we don't have the source of the data, it's very hard to take appropriate credit decisions. So I agree with you, and many times getting the infrastructure right is the most important factor, and then it's basically a springboard to get other people in. So I guess on your business, Dion, what would you say is most important? So when you walk into a meeting with an equity investor or a bank, what would be the different conversations you have, or what are the things that they're most interested in, would you say?
I mean, I was going to say, I think it's a little bit, for sure, I think it's a little bit different, right? I think if you're pitching, of course, to an equity investor, I think it's a lot more about, I think that long-term plan, right? How do you sort of step change your growth, right? A lot more. But I do think perhaps climate is also a little bit different already now. From the heydays, right, of 2021, where interest rates are really low, right? Everyone was sort of like blue skies, right? Type conversation. I do think equity investors, to be honest, have also evolved, or rather maybe have become a bit more conservative, a little bit more, slightly more risk adverse, right? And a little bit more muted in that way, right? To just see things a little bit more holistically. And I think now also actually asking very important questions, right? Which they should, right? Which I think the banks are asking. Right, I think for a business like ours, again, I think key things, right? Inventory turnover, all these things, basic fundamentals are extremely key, right? Because the death of most consumer brands, to be honest, is everything stuck in working capital, right? Everything stuck in inventory that you can't sell, and you're sitting on $10 million of goods that are stuck there. If you're perhaps not even us, and you're maybe a company that's not even DTC, but reliant on maybe wholesale businesses, is even sometimes worse, right? You're selling your beauty products to Sephora, they're paying you T plus 90, right? So imagine the lag time from a cash flow management standpoint, which is even higher, it's even higher risk. So I think conversations, at least maybe on the consumer sector side, right, I think have a little bit more converged, which I think is good. And yeah, I think if anything as well, I think our lessons also working more with the banks and conversations are a little bit different, right? So we have also trade facilities. And I think the important thing there also is the credibility of your partners, right? Of course, you need to establish a very good relationship with the banks, but I think very importantly is who are your vendors, right? Are they credible? Are they reputable? Are these really key vendors, right? Suppliers, right? Whatnot, that the banks would also be comfortable, right? To actually pay. And I think these are very different conversations, because sometimes when you're scaling up in the early days as well, maybe you don't think about that, right? You're just going for, who's the cheapest vendor, right? Let me go for that. Now, no longer that's the case, right? They have to also pass that due diligence. They have to be compliant, right? Governance, all of that. It's a whole different type of conversation. So I think in a way, moving into this sort of like debt journey for us has actually taught us also a lot more discipline, right? A lot more rigor. That I do think puts you in the right mode also, right? If you're moving on to the next stage in future of, let's say, operating with a private equity, for example, right, and raising from them, or perhaps you have also ambitions to then go on a listing journey as well, right, where governance, compliance, right, to Andy's point also, Big Four auditors, which we had also as our journey sort of like 2 years ago, these are all very important sort of foundations and just sort of the legwork that needs to be done. So I think going on that journey actually sort of forced us, right, to really be thinking about this and investing, right, a little bit more in that. Yeah.
Yeah. No, I think probably when you think about on the financing side, I mean, we'll deal with companies across different stages of the life cycle, right? Early stage, mid stage, late stage, and you're kind of going through these menu of different financing options. I mean, obviously, and I think in a more sophisticated market, a more developed market, you'll have those options available to you very easily. And I think we've always found in this part of the world, because every opportunity is very bespoke, it requires a lot of thinking around it. It's not essentially as straightforward for any issuer or founder to just click on a menu of options, right? It's essentially very much still human interaction, trying to sell the story, trying to think about ways to mitigate risk. So I guess from your side, obviously, you always are very polite, but I guess in many ways, where do you see gaps, or where do you think the financing landscape could improve? Because we do get into protracted discussions with banks, with credit risk committees, trying to sell the story. Like, where do you think we could basically cut the number of steps to kind of close the gaps? Because many times these are just automatic conversations that will happen because people are just debating things for the sake of debating them, and you'll never get there. Where do you see the bankers can do a better job?
Personally, I think the gap really is about how, and picking up on your first point, right, which is debt financing is a lot about historicals, while equity is a lot about looking at the future. I think a lot of banks, generally, or debt providers that are not so forward-looking, continue to have the same framework for the 20th century, fast forward to today, right, where a lot of the companies like ourselves are a lot more asset-light, for example, right? You don't have bricks and mortars to pledge or secure against. And as a high-growth company, at the end of the day, everybody's still scaling. If you use the traditional financial lens to evaluate us, right, you're going to only be able to, or banks or any debt providers will only be able to evaluate us 5 years later, right? And at that point, right, from a yield perspective, if you don't take the risk on us, then it's going to be not very interesting pricing for people, right? For the bankers, at least. So I do think the gap is really just trying to educate internal stakeholders that there is there are a lot of new companies forming, right? A lot of venture creation, and that playbook looks very different from real estate companies, manufacturing, traditional infra plays and stuff like that. So I think that education process needs to be there. And at the end of the day, at some level, it is almost like a project finance, right? Because project finance, you go into a project, right, with zero historical financials. It's all based on projections at the end of the day. It's all about how much equity you've put in, how much debt you're going to load. Yes, the only difference is there's fixed price contracts that you monetize. But if banks can wrap their heads around project finance with with strong execution risk as well in the first 3-5 years, then maybe they should have a different lens when they evaluate new ventures.
I was gonna maybe just add on to the last earlier question you asked just now, right? Sorry, something just came to mind. I think the moment you have, and just very candid talk, the moment you have sort of debt, equity, right, all on board as well, I think it's very important also for founders, right, to work with the board. Okay, maybe early days also sometimes, I guess, when I talk to also earlier stage founders and so on, right, I think to your point around growth and all, business plans can sometimes be a little bit lofty. Where it's very common, right? Sometimes for just, it's a little bit, the building blocks are not that clear. It can be a bit lofty, but the moment also you have debt on board, with the banks on board, is extremely important. And to be honest, I think I see the worlds converging, right? Because you can't breach certain covenants, right? I think that's the reality of it, where if you breach it with an equity investor, maybe it's a conversation, right? If you're breaching it with, debtors, it's a different conversation. Right, so again, I think that financial rigor, discipline when it comes to business planning also changes, right? That also, I think, not just the operators and founders, but the board also takes a different view also, right? When you're thinking about your business plan and thinking about your forecast as well. Sorry, and your question for this time, maybe?
I think it's just...
I just wanted to share that because I think it's a very, very important point actually for founders also to switch gears.
Yeah, you're right. I think a lot of it's a partnership with the banks, right? Because many times, say, when you're setting covenants, they'll be very unique for different industry, different company, right? And in many ways, as long as you define this is what you're going to use, will you stick to it? And will we stick to it? And ultimately, it doesn't change over time, because then at least you're showing some commitment to meeting those requirements. But I guess in terms of like a commercial nature of banks or capital providers you deal with, do you see a gap in the market? And do you see that if that were to basically get fixed, is there a lot more that you could achieve in terms of financing perspective?
Yeah, no, I was going to say, I think, to be honest, I think just again from personal journey, right? I think as Love Bonito, we have honestly been quite fortunate on like the debt side with conversations also with the banks, because I guess end of the day, perhaps maybe because we're quite established, right, in Singapore, and I don't mean this in a cocky way, right? I think it's just more we feel fortunate, right? I think we've been around for quite a while, and a lot of times, of course, with the banks, it's still a slightly more conservative and traditional conversation, right? I think people like to see precedents. People like to see a track record. People like to see reputation, right, and credibility. And it helps that we've been around for 15 years. It helps that we've been around for a while, you know. So I do think, and versus the conversations I've had maybe with founders who maybe have had struggles, right, sort of just getting loans and so on from a lot of the different banks, and it's been just a lot of closed doors. So I think that really just helped us, right? I think from day one, just a little bit more of the reputation. But again, I think to what we talked about just now, fundamentals do matter, right? I think for us, if you're going, example, brick and mortar, just basic fundamentals like payback period, right? All these things, it matters. And it's very important, and you have to hold yourself to that. Because if not, I mean, it's not so much even for the bank saying no, because if not, then just operator to operator, I would just advise you not to even take debt, right? If your payback periods are not healthy, because you're just putting yourself in a not so safe position down the line. But maybe to your question, I think if I think about the new generation of consumer brands, not us, because we're very omni-channel, perhaps the brands that are maybe even very TikTok driven, all of that, where sales are very, very lumpy, right? And they're selling, and I see so many brands today in the Philippines and Thailand, they're easily hitting 5 million, 10 million, right? In terms of like annual recurring revenues, right? Just off TikTok, right? But sales are extremely lumpy. You're maybe hitting a spike on 11/11, then on 12/12. I think those perhaps brands like that, I do think perhaps banks today maybe have struggled still understanding, and it seems a little bit risky, right? Like, like it's not really that consistent, right? It's very, very spiky. You're not really sure, right, as well. So I think maybe that is where also I think we all just probably need to evolve, because this is the new mode of commerce, right? We're also sort of even diversifying and exploring more of social commerce and all these moments, but it is the new mode of commerce where it's no longer brick and mortar as well, right? It's no longer so, in a sense, maybe that steady state. If you think about an offline channel sales, online I would say is extremely spiky, right? So I think if that's the new mode of commerce, I think everyone needs to sort of just understand and be a little bit more comfortable around that as well. Yeah.
Sure. And I mean, you touched on a point around growth, going into new markets. And I guess we're saying on the asset side, you're seeing that business diversify. Banks may be capped out at some level, right? And the key is that how do you diversify capital providers to meet your needs across the spectrum? So I guess, Tommy, a question for you is on the private banking side. I mean, we've seen different pockets or instances where a lot of credit is sold to the private credit investor base. The private bank investor base. I mean, can you touch on in terms of that market growing and sort of the potential of that market to fulfill the gaps where the traditional commercial banks cannot meet? It's beyond our credit risk appetite, but where there are additional pockets of liquidity through the private banks, through founders that would know the business quite deeply, and how do you essentially help to close the gaps ultimately where the banks may be capped out of their appetite?
Yeah, great questions. I would put it this way. Fixed income or debt in general make up the bulk of any private banking client's portfolio. So if anyone has $100 to invest, good 50, 40, 60% of that $100 will go into some form of debt instrument. So I'm very certain that for the two companies that you're responsible, very soon you will graduate from the bank lending space to the more institutional fixed income or institutional bond space. What we have seen in the private banking world is people moving the other way around, meaning historically they will invest in investment grade, closer to home in Asia, and then they will move to investment grade in the US, and then to high yield, and then to private credit. That's kind of the journey that we have seen. But I'll share with you one perspective. I spent most of my life in the fixed income market in the investment bank. So I think I know credit investor quite well. I'll tell you this, they are generally very grumpy because their upside is getting their coupon, their downside is losing 100%. And they all have very long memories. So the guys who operate in Asia, they still talk about what happened in 97 and 98. The people who operate in US, they still talk about WorldCom and Enron that happened 25 years ago. So I think what Dion said about having the right vendor or having the right partners really makes a meaningful difference, because quite often is not just about fundamental, which I classify as the ability to pay, but it's more the willingness to pay and the reputation of these founders and these company executives. Because very recently, just a few years ago in China, we saw that problem. Pretty much every large cap real estate developer defaulted. And I'll tell you, probably 20-30% of them do or did have the ability to repay. They just say, forget it. Most of my competitors are not paying. Why am I wasting my money repaying the bank? So I'm going to default and walk away. So I think the comment you make about having the right vendor, the right partner, having a long history of repayment and live by your words I think it will serve all of you and all of us very well if you're looking to build that capital structure over time, from equity to debt to the institutional bank space.
Yeah, just to add, Tommy, in terms of, I guess, when you're selling products to your private banking investors, I always say on our side, when we're selling a company story to our bank internally, the way you articulate is the most important thing. And that's always the kind of key defining point. Quality of data and ability to articulate in very, very simple terms, so that ultimately you're breaking down the business model into very simple terms and you're building it up in terms of how the credit story stacks up. Would you say the private bank investors, would you say from your experience working in a bank, private bank, how different is the story that's being told? Is it essentially the same kind of way you articulate the story, or what are things that they would look for that's quite different, would you say?
I think when I talk to an ultra high net worth clients, I probably have about 2 minutes to make a pitch. So I would tell all the founders, think in the same way, right? You have 2 minutes. How do you pitch your story? And quite often it's not just about your company, but about yourself as well. So we try to do do things the same way, because most of our clients, they are so busy. Every day they have 20 bankers trying to pitch them something, 30 founders who want to teach them, pitch them their own companies. They have very limited time, limited attention span, so you really need to articulate, your story very clearly to get their attention. And always focus on the most critical questions.
Yeah, absolutely. And I guess really rounding out the discussion, Andy and Dion, what advice would you give to founders looking to tap the capital markets, right? Whether it's the private bank markets or basically progressing around the syndicated loan markets, eventually the bond markets, it's a long journey, right? And I guess working alongside with you, there's a lot that goes on behind the scenes that people don't see, right? It's how do you sell the story? How do you get a head around the numbers? How do you basically get people under the hood, make them partners? But what would you say to people who have that aspiration? They see the benefit, particularly a capital-intensive business like yourselves, where you need to raise cost-effective funding to generate the unit economics and reach those heights. What would you say to any founder looking at that multi-year journey, let's say?
I think it goes back to the original premise, right? Which is that I think once a company or founder have decided that in 3 to 5 years' time is a journey, right? You build credibility. You want to tap the debt market, either bilateral, syndicated, or otherwise, right? You need to build the foundations today or yesterday, right? And I know founders are very interested in grabbing the next sort of dollar of revenue, income, cost control, etc., but at some point, you do need to build and invest in the people that are going to deliver the debt for you at the end of the day, which is finance, the corporate services. You do need your legal, you do need legal counsels within in-house that can help you think about some of the risk that you are taking on, right, in entering some of this debt partnership. You do need to pay for higher costs for Big Four auditors, especially. There are all these costs that if you were starting out today, for example, at pre-seed and all of that, probably don't think about that, and you're like, I only want to hire engineers. Who cares about corporate services, right? But if you do want to tap on that in 3-5 years at a certain point of your journey, you do need to invest in that. And it's not just
throwaway costs, right? The data needs to be clean. We are always looking at our data integrity. Engineers, yeah, sure, it's important for growth, right? But if you do want to grow with that, you actually do need to lay the foundations sooner rather than later, because conversations take time. The entire company getting ready to raise your first dollar of debt is going to take time. So I do urge founders to really consider it, and if you want to embark on it, then you need to bite the bullet and invest in the right resources and the right people and the right professionals that will help you, not just engineers and data scientists, unfortunately.
No, I think as you were speaking, Andy, I mean, another thought that came to my mind was around, I guess even the Tomy business model, they've always stuck to one story about what they do, and it's never deviated from that. So it may go towards other jurisdictions, other types of products. Is that core fundamental business that doesn't change? And I think as a credit provider, that's always very comforting, right? Because you almost like have doubled down on what you're doing. You're just using what you have learned to offer it better and go broader. And I imagine, I guess, Dion, as well, from your business, how important is it to sort of stick to the fundamentals? What you said at the very beginning, this is what I'm going to do. And as it works, you stick to that rather than dabbling in many different things. Because there are many different ways to go. And I think we see that the best businesses are the ones that can scale. Your ability to scale is really around trying to reinvest in what you're doing and maybe doing it in a slightly different way, doing it in other markets. But you're not essentially having another core business line that is very different to your core initial place that you started from. Yeah.
I mean, I think it depends on how much capital you have, right? Capital is finite when it comes to R&Ding, prototyping, right, ring fencing, and having that confidence to perhaps try something new, right, and being okay as well that if it fails, right, entirely, right, and this new business unit, fine, right, I'm fine, write it off, I move forward. I think of course it's a factor of just capital, right, and thinking about that. But then I think just back to this topic as well, I think Andy covered it really well, right, I think in summary. But yeah, I would say focus really still on the fundamentals. I think that's key in the early days, regardless. Of course, experiment, pivot quickly. I think there are ways of prototyping and experimenting very quickly in a very cost-efficient manner as well, right? I'll give an example. Even consumer brand today, there are very different ways, right? If you want to do something a little bit more like creative, like drop shipping, right? Pre-ordering, there are many ways to try to test something new without actually having to be sapped into inventory. Those are ways that you can actually test first and just validate an idea before going deeper. But thereafter, then still focusing then on the fundamentals and doubling down a little bit, because no matter what, equity or debt, right, investors are going to be asking you still, right, and they will want to understand, right, sort of like what are the recurring revenues, right, what is your customer cohort looking like? Is it not just an NC game, but how are ECs and returning and repurchase and LTV actually looking like? I think those are very critical questions that you will have to answer anyway. So I think it's very key. And I would say maybe just the one thing, since we're on this conversation, not because you're paying me to say that, but I think founders should be more open to being open to exploring debt in the early days, right? If you were even a marketing tool, SaaS tool, there are revenue-based financing, like, options today. Like, there weren't actually that many options like that, for example, in this region in the past, and they used to be only quite US-based. There are a lot more options like that right now, right? So I think it's important to just consider them earlier on versus later on as well. Because again, right, to the point of dilution, all of that as well, in the early stage is when you're probably going to dilute the most, right? Because you don't have that bargaining power, right, with a lot of the investors as well in early stage. So I think that's really something quite key to just think about, would be just the one word of advice as well, just to be a little bit more open, right, to debt investors.
Okay, awesome. So I think we basically have about time right now. Any other comments you want to make, Andy, Dion, Tommy?
No, I think the only comment I would make is to echo Dion's point. I do think that founders need to be more open to debt in general, and don't be scared off when people say, I need 15% per annum interest, right? And then you're like, my fixed deposit is at 2%. Why are you charging me 15, for example? But I do think that there is a risk that they may not get money paid back, repaid, right? That is a risk they take. But think about it, equity is a lot more expensive. And you actually need the professionals to calculate and show you why it's more expensive. Dilution is more expensive, especially if you do believe that the growth is going to be, 10 times, 100 times, right? So there are other capital toolkits other than pure equity. Although you do need credible equity capital as a start,
right? Thereafter, that should always be in everybody's sort of playbook to augment your returns and perhaps create better exits.
Fantastic. Thank you very much. And thanks to Andy, Dion, Tommy. Great insights. And yeah, thanks everyone for attending the session today. Thank you.
Thank
Thank
you.
you.
you.